the Fed slash large mutual funds conspire to tank the market and to some extent take Tesla with it despite great performance. This is Greg for Teslafaninsight. Thanks once again for joining us. If this is your first time, welcome. If you're a repeat visitor, welcome back. We also want to thank our Patreon supporters. Your support is greatly appreciated and makes all the difference for the existence and viability of the channel. So we've been away for a while, and the main reason is that typically we've actually got a number of viewers like yourself who've benefited over time from the forward-looking analysis that we've provided, and we take the impact seriously and look forward to finding ways to deliver value. So the biggest reason for the delay in our talk is that the Fed actually came out with the 3/4 point increase. But not only did they come out with the increase, but they also pointed out that they still had about 4 points worth of increases to go. And so we wanted to take a look at different aspects of this and how it affects stocks, including Tesla. So as a reminder, I want to go back, let's say 2.5 years ago, when the Fed had actually lowered rates all the way to basically zero. You know, there's a goal there to stimulate the economy, to get things moving once again. So in particular, the people that the Fed was focused on is senior citizens, many of whom are on fixed incomes. So the basic idea was that we need to boost the economy, we need to help the companies get funding at low cost to help fuel jobs, etc. And the way to do that was for them to lower the interest rates. And this had a number of impacts. In particular, this was sort of an attack on senior citizens. So basically, if you're on a fixed income and you had a government bond and you had a decent rate of return, the income from that could supplement your Social Security, etc., so life would be fine. So what ended up happening was, and by the way, seniors are the largest savers, so that's also why they were kind of the target of the Fed. So if you think about it, what happened was that the Fed basically forced seniors to jump over to stocks to find, if you will, growth or yield that they were not getting on their bonds. So this brought in sort of a new situation that's been in place perhaps for the last 2.5 years, where the stock market actually did extremely well. Why? Seniors who couldn't get yield on their bonds were jumping over the stocks, and the additional capital sitting in stocks meant that, let's say stock prices were somewhat high, they would go higher because there was little choice for those needing sort of growth in the value of their investments than to jump over to stocks. So let's fast forward to what's going on now. We're in a situation where the Fed is working hard to control inflation. The stated goal is about 2%, and we're currently at 9%. So obviously, so the one way to do that is to increase interest rates. So the question is, what happens when we increase those interest rates? Well, basically, all those seniors who could not get yield have now switched over to bonds, and they can afford to switch to bonds because they're getting yields that are high enough to allow them to not have to worry about trying to get that yield by an increasing stock price or perhaps dividends being paid by stocks that are doing well. So this change in process, I believe, has the potential to, if continued, to hit the stock market at least by 20, maybe even 40% down, because you have so much capital that's moving away from the market into fixed incomes. And it all makes sense along the lines of what I've just been describing. We talked about the change in the market multiple. Well, if you have all these individuals who have their money in, let's say, a Vanguard, and they've decided to ship all most or all that capital over to bond funds, all of that capital is no longer sitting there for companies to use at low rates to continue fueling growth. So you can kind of see what's going on here. So in general, what this means then is that stocks that might be getting a market multiple a year or two ago that was a certain number, it's going to perhaps be 25% less in the current environment, and perhaps go lower depending on the growth and profitability of the business that they're in. In Tesla's case, I think it's a little frustrating because they're still doing great numbers. The problem is that how much people are willing to pay up for certain stocks has declined simply because of how we're sitting right now in terms of where the economy is, how much capital is being moved over to bonds, and all of that capital not being available to invest in corporations. So I think a big part of our delay in recent comment was to say, hey, let's take a look at realistically what's happening and figure out whether or not this environment is a good place to buy, sell, or hold what you own. As you know, Tesla continues to do quite well. There is discussions about the wait times in China dropping from 6 months to as little as 30 to 60 days. So does that mean that a worsening economy is affecting people's ability to buy or willingness to buy? There's some unknowns that are associated with that, and that plays into the narrative of, do we still keep paying premiums for the stock if we're not seeing the consumer demand component? Let's review the fact that the determinant of the stock price is not only is the growth rate in earnings, but that backlog is a really big deal because it's a sign of future business and sort of where things are going. And to have that backlog declining anywhere is not good news, especially in a market like China where you're looking for huge growth over time. So I'm not that worried about it because we have so many places like Australia, et cetera, that are desperate for any EV right now because they have such an efficient environment for those EVs. So the question is sort of what next, and the end portion of my discussion is something called the artificial recession. So one of my favorite statistics that's out there that I learned many years ago when I was just doing a lot of auto reviews is that there's a 7-to-1 ratio in the auto business. So for every auto union job across the United States, there are 7 people's jobs that sit behind that. It could be your dry cleaner, your attorney, your lawn guy. There are all these different people that rely on that union job, if you will, to fuel sort of how well they're doing. So obviously when any companies, including auto, are doing well, there's kind of a multiplier for all jobs that are within large corporations along the lines of what I just described. So why this is a big deal is there's an interesting battle that's brewing between the Fed and the president. And that is that in the defense industry, as you'll notice, right now, there's a place called Poland that's ordered 500 HIMARS systems. So that's 500 of the trucks, along with thousands of munitions to support those trucks as they gear up in Poland. I can deliberately mention what that number is because it's been well publicized and you can take a look. But what's the ratio of jobs to orders for a place for the manufacturer of HIMARS, Lockheed Martin, in Arkansas? Well, you could say, that's like $4 or $5 billion in orders, plus all the rockets that are going to be sent with those. Well, that number could be, upwards of $10 billion there just for that one country. The U.S. is increasing its supplies for itself, as well as a number of other allies that have gotten on the back end of that order list. So what's happened is that the plant that was operating to supply has now increased, has this huge backlog, and they have to increase the number of employees. So one could argue, let's say, for every HIMARS system out there, maybe there are 3 to 5 people who have to be hired behind each of those workers to support or that kind of support that growth. Why there's a battle between President and Fed is that every time we hear of Zelensky and Ukraine getting more weaponry, that means there's more money being spent on munitions. And each of those companies that are getting these orders are increasing or maintaining their worker supply. They're not firing anybody, and they're trying to find more people to work within those facilities. So it's created an interesting situation, which is one of the ways to reduce inflation is to help people get fired from their jobs. And one of the ways to do that is high interest rates where companies can't finance to keep operating nicely. And so on one hand, you have the Fed engaging in tactics that theoretically will result in job loss. On the other hand, you have entities like Lockheed Martin and all the other companies, Raytheon, et cetera, that are benefiting from all the activities going on in Ukraine with Russia. So I believe this is this is why I'm calling it kind of an artificial recession. I had a conversation with an investment advisor. We were talking about, wouldn't it be a good idea to dive heavily into oil right now and oil services because of, closing on $100 a barrel. That's an excellent number. And he asked me a question. He said, well, that sounds good, but what if hostilities end early in Russia or something of that ilk? Well, all of a sudden you have what is a $100 price for a barrel dropping to about 50 in terms of realistically supply and demand. And so all of your efforts to invest in that sector to get that coupon or yield kind of disappears quickly potentially. And now you're stuck with the rotational costs out of one industry to the other. And I have to say, I spoke with him maybe 3 months ago, and when oil has gone from 120 a barrel now, dropped below 80 today. And the trend, I believe, heads us further into that, $60 to $70 a barrel zone because of the $30 discount the Russians have been offering. So what I'm chasing here is the fact that, it's entirely possible that a dramatic change in Russia results in a lot of the recession challenges that is being held in the economy around the globe suddenly disappearing. In the case of natural gas, they'd been relying on Russia for a really long time, and the price has gone to 10 times what it was prior to the war. And that means there are a lot of people who are having difficulty finding supplies heading into a cold winter in Europe, and their manufacturers shutting down because their cost of goods have risen so much, primarily because of the fuel cost issues. So I bring all this up in general, though, to just suggest that we're actually in a fairly unusual environment where, yes, we have a recession coming in. That recession is driven by costs rising and high employment. And so the Fed is using the lever that it can, in essence, to reduce business activity. And I guess it's starting to work a little bit, but it's sort of a stubborn environment where companies continue to do well and hire people despite the Fed's efforts to have it go the other way. And this is why I brought up the issue of defense contractors still hiring and looking at that giant backlog over time and not firing anybody. And so, in essence, the Pentagon is causing the Fed problems, and they're trying to find ways to force the Pentagon to get rid of people, and it's not working. So what's the answer to this? Well, obviously, if we somehow ended the Russian hostilities, I think that would help. But the issue is there's no clean answer. And given the high inflation rate that we're seeing, we do know about that issue. So therefore, they can go after it. And in theory, they can reverse course going forward. How might a smart investor address this? Well, I have to say that some of the government bonds right now, given where the Fed is going with interest rates, look really good. Or even, trading options on bonds might be good here because we know that those interest rates are going higher. We also know that those higher interest rates are going to lower the value of equities for everybody, including Tesla, because a lot of money that was sitting in the mutual fund on the stock side of the house is now going to start shifting heavily towards the bonds, both because they can get great yields right now, and those yields are continuing to rise. So I'd have to say that everything going on isn't terrific. It does make sense, and either you line up and stick with your stock like a Tesla for the long haul and enjoy, or maybe introduce some strategies designed to mitigate the negative impact of where the Fed is going with the economy. So we really look forward to your comments on all this. I do think it's weird to have the internal government battle between helping to facilitate more jobs versus helping to get rid of jobs going on at the same time in buildings very close to each other. Our health tip today is just a reminder: a 15-minute walk every morning will allow you to consume the calories of the day, and then if you work out more, that'll begin to cut into your fat stores and I think result in overall better health and less weight. This is Greg for Teslafaninsight. Tschüss, German, au revoir, French, Lehitrot, Hebrew, Choda Hafez, Farsi, Tadaj, we say Russian, Ni Hao Ma, Chinese. In Jamaica, we say Enough respect, walk, good man. Thanks for joining us. Have a great day, and we look forward to your comments on this.